Okay, well, welcome and good afternoon. My name is Peter Mills with Fiducial Business Centers, and I'm giving this presentation to you today from Columbia, Maryland. And we do have a pretty good rainstorm going on outside, and so if you hear some background noise while I'm speaking, it's probably the rain falling, so I apologize about that. We wanted to talk to you a little bit today about the consequences of a very important recent Supreme Court decision having to do with sales taxes and how that might impact you as a small business owner. So to start out here, I just wanted to explain some of the basic concepts behind this case. So for many years, the rule used to be what was called the physical presence test. And so what that meant was that a business owner could not be required to collect sales tax from its customers unless that business had a physical presence within the state. So the physical presence test is now out, and now we have something called substantial nexus, which I'll get to in a moment. So this case was centered around a law that was passed in South Dakota. And the South Dakota legislature enacted a law that said if you are a remote seller and you have, on an annual basis, if you sell $100,000 or aggregate or 200 total transactions into the state of South Dakota, then you have to collect and remit sales tax for those South Dakota sales. And other states have also enacted different rules, which we'll get to in a moment. So sales and use taxes are similar but not quite the same. They're complementary to one another. So sales taxes are what people are most familiar with. Sales taxes are collected on the sale of goods at the point of sale, basically. So sales taxes are levied on the sale of goods and some services, and sales taxes are collected by the merchant and then remitted to the taxing authority directly. Use taxes are similar but different. So use taxes are not collected by the merchant. Instead, use taxes have to be paid by the consumer directly to the state taxing authority. And this comes into play where if the consumer makes a purchase that is taxable, but a tax was not collected by the merchant at the point of sale. So this graphic here kind of gives a visual illustration of the concept of substantial nexus and how it works. So the Supreme Court said that in order for a state to require a seller to collect and pay over sales tax, they have to have substantial nexus within that state. So as I said a few minutes ago, for many years the rule was that you had to have a physical presence within that state, and that's the box there on the left. So what the Supreme Court has said now is that physical presence is not the only way of getting there. There are multiple ways of getting to substantial nexus. So you can establish substantial nexus through physical presence or through economic nexus, or even through other forms. And a lot of these things have yet to be fully explored and defined, but will be through future litigation. So Justice Kennedy wrote the decision for the majority in Wayfair, and he actually switched sides from the position that he took in a previous case many years ago. So physical presence is no longer required to establish substantial nexus. Justice Kennedy said that this is very out of step with current economic realities, and he actually wrote several pages about how pervasive e-commerce has become, and so forth, and how it's just not practical to require a physical presence anymore. And then the Supreme Court, as they often do, they issued a very narrow ruling in this case, and they said, look, we're only going to rule on the physical presence issue, and then they remanded the case back to South Dakota courts for consideration of other issues. Justice Kennedy has some positive things to say about the South Dakota regime. The first point that he made, he said, well, we like this regime because there's a threshold. And so the annual threshold of $100,000 or 200 transactions serves to exempt or kind of provide a carve out or a safe harbor for the very smallest, very smallest businesses and small taxpayers so that they won't be impacted by this. He also said, we like that it's not retroactive. And that was one thing that was specifically written into the South Dakota law, that there was to be no retroactive application or retroactive collection of sales tax. And then Kennedy also said, we like the fact that South Dakota has adopted the streamlined sales and use tax agreement, which in his view makes it easier on taxpayers, lessens the administrative burden of collecting and reporting sales tax. So now that we have this decision from the Supreme Court, what comes next? Well, so we have this concept of substantial nexus, but the problem is that it's not really defined. Nobody knows exactly what this means yet. The court said you have to have substantial nexus, and they said, well, we think South Dakota's law, which they established this threshold of $100,000 or 200 transactions, we think that that's good enough to show substantial nexus, but we don't know where exactly that line is. And so other states have already enacted laws of their own. Some states have used the South Dakota threshold, and some states have used different thresholds. And so we don't ultimately know where this line is for showing of substantial nexus yet. And it will probably take many more years of litigation as things work through the courts to find that out. Another thing that could happen in the future is that Congress could enact legislation to overrule or limit the impact of the Wayfair case. One thing that Congress does have the authority to do, if it wants to do it, is to regulate interstate commerce. And so Congress could step in and enact legislation and say, okay, we're going to decide on a national basis what this threshold should be. And there has in fact been legislation proposed in Congress that would do just that, although it's not currently gaining any traction. Many states have already enacted laws that follow South Dakota's. Some follow it exactly, and some don't. Some have set up different standards, as I'll show you in a moment here. And so to evaluate the situation for your business, it's important to be aware of these differences, which are always evolving. So here, just to kind of illustrate this, here's a map that the folks at Bloomberg Tax put together that shows, and this was current as of July 11th, that shows kind of where things are right now. And so the states in blue, and again, this was as of July 11th, the states in blue are states that have enacted an economic nexus standard. And then you can see the other colors. Some states have proposed legislation, and some states have different regimes. And this is always evolving and changing. And I know that actually since this map was published, my own state of Maryland, has enacted an economic nexus standard. So here are a few examples of the variation that I was telling you about. So one thing that's important to pay attention to is the words that are used in the law. So for example, South Dakota, they said, okay, our threshold is going to be $100,000 or 200 transactions. Massachusetts says we're going to make it $500,000 and 100 transactions. So some states use or and some states use and. New York says we want our standard to be $300,000 and 100 transactions. Alabama says we're just going to have a straight $250,000 threshold with no minimum number of transactions. Pennsylvania has the lowest threshold that I could find anywhere, and they set their threshold at $10,000, which is very low. $10,000 and no minimum number of transactions. And then the state of Washington has this interesting two-tiered system. And so if you have $100,000 or 200 transactions in a year, then you have to collect sales tax. And if you have $10,000 worth of transactions, you can make a choice. If you're a merchant, you can choose to either collect the sales tax, or you don't have to collect, you have to report, basically. And at the end of the year, you would report to the taxing authority your sales and the customers that you sold your products to. Presumably, so then the state of Washington could go collect the tax from the end customers. So now I want to spend a few minutes talking about some planning points and things to be aware of for your business. The first thing you need to know, keep in mind, is to know where and when you need to file. So to do that, you need to evaluate your business practices very carefully. Make sure you have a handle on what's going on, know what you're doing, know who you're selling to, know where it's going, and know where you are buying things from as well, buying your supplies. You need to identify filing jurisdictions where you may have nexus, and you need to look at two things. First is you need to look at these new economic thresholds to see if you may have triggered the nexus rules there. But also you need to look at the traditional physical presence rules as well, because you might have already have established nexus in a state through having a physical presence there, and perhaps you weren't even aware of it. So as you make this assessment, you need to take in mind not only your current liabilities, but maybe your historical liabilities as well, because maybe you had nexus in a state and you weren't aware of it. Maybe you've been in a state for a while and you just didn't know that you were subject to the rules. So after you make this assessment, then if necessary, you need to register to collect sales tax after determining your best options, which I'll explain in a moment. Because once you register, that sets a number of things in motion. Also, you need to be aware of effective dates, bearing in mind that there are a lot of differences between the states. Some states have enacted their economic nexus thresholds effective July 1st. Some go into effect August or October 1st. There are lots of different dates to keep in mind. And also be aware of local taxing jurisdictions. It's not just the states that you have to be concerned with, because many counties, cities, and municipalities also impose their own sales taxes. Also, you need to know what should be taxed, what types of goods and services need to be taxed, and where they should be taxed. And so I was doing a little bit of research, and I wanted to find some examples to illustrate the types of variations in how goods are taxed. And some of them are not as obvious as you might think. So for example, a Twix bar. Is a Twix bar a food item or is it a candy item? Well, the answer depends on where you are. And the state of Illinois considers the Twix bar to be a food item and not a candy item. The reason being that a Twix bar has flour in it, and so therefore the state of Illinois considers a Twix bar to be food. And so in the state of Illinois, a Twix bar is not taxed because it's food and not candy. Yarn. In the state of New Jersey, if you buy yarn, whether or not it's taxed depends on what it's used for. So if you buy yarn to use in an art project, it's taxable. If you buy yarn to make clothing, it's not taxable. And in the state of Texas, deodorant may or may not be taxable depending on what is in the deodorant. So in the state of Texas, if your deodorant has antiperspirant in it, it's not taxable. If it does not, then it is taxable. And so there are many, many, many more examples, and but just for purposes of time, I've only limited to these three here. But I just wanted to illustrate type of variation that is out there in the states and the local taxing jurisdictions. And so it's important to be aware of what you are selling and how it might be categorized by the rules of your jurisdiction. Also, if you're selling digital products or if you're selling services, these types of things may be very difficult to categorize. And in many cases, state laws and regulations don't provide us with sufficient clarity. It often happens that state laws are kind of behind the times. And so as technology evolves and commerce evolves, sometimes the laws don't move quickly enough to catch up with that. And so you may find yourself in a situation where there is not sufficient clarity or something is not adequately defined by your state laws. It's also important to evaluate any ancillary products and services that may be offered by your business. So for example, if you're selling goods, if you're selling widgets and you're shipping widgets out to your customers. Are shipping charges taxable? Well, that depends on the state that you're in. What about a handling charge as opposed to a shipping charge? Is that taxable or is it not taxable? What if shipping and handling are bundled together? Again, the answer is different depending on where you are. What about other services like installation or maintenance or training and setup services, things like that? Again, the answer may depend on where you are. In some cases, the delivery address of your customer may not be known or may not be available. If you're just selling a digital product that somebody is downloading, you may not know where your customer is sometimes, and that can be an issue. Another important thing to do is to evaluate the resources that you have on hand and to make a plan. You need to take a hard look at your current business resources and see if you have enough resources to fully comply with the tax laws. In some cases, you may need to make some upgrades to your business in terms of upgrading your technology, upgrading your software and tracking systems. You may even need to take on additional personnel to help you keep track of everything. It would be very good to create a written plan for maintaining compliance. Create a written plan for what you intend to do, how you're going to stay compliant. Create a written plan for how you're going to stay informed of changes to the laws. And just as I've been monitoring this sales tax issue, I've seen the laws changing almost every week. New laws and guidance coming out from the various states, changing very rapidly. So you need to create a plan for how you're going to monitor and be aware of state laws, regulations, and other guidance. Another thing that you need to do is you should not assume that your suppliers are getting things right. You need to pay close attention to your supplier invoices to see if they are over or undercharging you for sales tax. If they're charging you too much, then you're losing money. And if they're not charging you enough, then you could be liable for the shortage. So what if you have not been compliant? Maybe you just weren't aware of the regulations, and what if you were not compliant for a period of time? What do you do about it? Well, there are states that have voluntary disclosure programs. And if you remember a few minutes ago, when I said one of the things that you may need to do is register to collect sales tax, but only after evaluating your best options. Well, this is one reason why. If you want to take advantage of a voluntary disclosure program, one of the requirements generally is that you cannot have filed any prior tax returns for the tax concerned. So in other words, if you have never collected a sales tax in the state or never registered to collect sales tax in a state, then you may be eligible for a voluntary disclosure program. But in most cases, as soon as you file paperwork with the state, then you lose that eligibility. So right now, there are 38 states and the District of Columbia that participate in the Multi-State Tax Commission's voluntary disclosure program. I've provided a link there on the slide for you to look at. So there are some advantages to this. The first advantage is that it remains confidential until an agreement is reached with the state or states you are negotiating with. So in other words, you can put your proposal forward, and the state taxing authority will look at it, and they'll say, yes, we agree, or we're going to make a counteroffer, but your identity stays confidential until an agreement is reached. Under these voluntary disclosure programs, penalties are generally waived, but interest is still generally charged for any past tax that is due. And you're not eligible if you are under audit, or if you've had prior contact or filed prior tax returns for the type of tax concerned. Minimum tax liability is generally $500. If it's less than $500, they expect you to pay it. Another important thing to bear in mind is that the state can still audit your records for the look-back period. So in other words, you make a voluntary disclosure agreement that covers the last 3 years. And you say, okay, I'm going to pay the taxes and interest due that are due for the last 3 years. Well, the state will accept that, but they will still reserve the right to go back and look at your records to make sure that you calculated the tax correctly. So that's something important to bear in mind. Another thing to be aware of is that some states may be offering amnesty programs. And the Sales Tax Institute is an organization that keeps track of this, and I provided a link here on the slide for that as well. There are 4 states that currently have active amnesty programs: Alabama, Connecticut, Indiana, and Tennessee. New Jersey and South Carolina have announced programs or plans for future amnesty programs. And other states have had amnesty programs in the past that have expired or run out. But these are the 4 states that have them currently. And as you can see, they offer different terms and different benefits. Alabama will waive penalties and interest. Connecticut will waive penalties and half the interest. Indiana will waive taxes prior to 2017 and then waive penalties and interest. And then Tennessee is the most generous currently, waiving all tax penalties and interest. There are some other pitfalls that are important to keep in mind. The first pitfall is this transaction threshold. And so once this threshold is crossed, you are liable for tax on all transactions. And I put an example here that kind of illustrates this. So going back to the South Dakota rule that I talked about at the beginning of the presentation. So the South Dakota threshold was 200 transactions. So if you're a small business owner and you had 200 sales going into the state of South Dakota, if you have 200 transactions, then you have to remit sales tax for all of those transactions. If you only had 199 transactions, then you don't have to remit sales tax for those transactions. But the point I'm making here is what happens if you hit that 200th transaction and you have not collected sales tax for your first 199. If you haven't collected sales tax from your customers, then South Dakota is quite likely going to be knocking at your door, expecting you to pay up that full amount. Something to bear in mind. Another potential pitfall is that the way many of these laws are written, the thresholds can be related back to the prior year. They can apply to the current or prior year. And I've put an example here that kind of illustrates that. So again, if we're applying South Dakota law, so say in year 1 you had 200 transactions going into South Dakota. So well, we know already you would have to remit sales tax for those 200 transactions in year 1. In year 2, supposing you only had 50 transactions going into the state of South Dakota, and you might think initially, oh, well, I'm under the threshold, so I don't have to remit sales tax. Well, that's not true, because the way the South Dakota law is written, the South Dakota law says that if you had 200 transactions in the current or prior year, then you have to remit sales tax. So under this example here, you would still have to remit sales tax for those 50 transactions in year 2, even though it was under 200. Then another thing to be aware of is that in the future, states may attempt to apply economic nexus rules to income tax liability as well as sales tax liability. Now, traditionally, income tax liability has been tied to having some kind of a physical presence within a state. However, now the door has been opened for that to possibly be changed in the future. And so we may see the day when states will require taxpayers to file and pay income taxes based on having an economic nexus in that state. And this could also have implications for your business's financial and accounting statements. And there are two that may bear particular attention. There's ASC 740, which deals with income taxes, and ASC 450, that deals with sales and use taxes. And so finally, we just want to thank you for your time and your interest this afternoon. And here's our contact information, and please feel free to follow up if you have any questions or if we can help you. Thanks very much.